The S&P 500 is down about 18% from its all-time highs, and looking at the pre-market, it looks like today will be no different. Currently trading at $493 a share. So what I'm going to be doing today is looking at everybody's favorite stock, Berkshire Hathaway, everyone's favorite stock at the minute, that is. You can see it is currently trading at $483 a share, down 2% in the pre-market, but year to date the stock is up 18% and actually up 150% over the last 5 years. What I'm going to be doing is going through my automated stock valuation spreadsheet, seeing if Berkshire Hathaway is a buy or sell using the discounted free cash flow model, comparable company model, and Ben Graham formula for intrinsic value. So we'll put in the tick I already have, BRK. This will load up all the latest company financial data for Berkshire Hathaway, and then we can have a deeper look. Now, some of these won't be exactly right. This is because it's split between the BRK numbers and BRK numbers, so some of the ratios are a bit off while looking at the Class B shares, which are a much lower price due to their, the BRK shares are currently about 700,000. BRK is about 490, so I think it is 1,500 times less, or that is what the splits are, and there was many splits to get to this price. But anyway, about $1 billion in market cap, P very low, we're not going to look at that. BRK has a P ratio of around about 12, which is obviously a lot lower than the market average, which is currently, 25.2. That's the lowest I've seen it in quite a while. Earnings per share, quite high, but yeah, as we've seen before. Beta 0.8, meaning it's less volatile than market, and analysts do say it is a buy. Berkshire famously does not pay a dividend. So having a look at the revenues, trailing 12 months, all-time highs, 371.43 billion, increased from the prior year and has been steadily increasing for as long as we can remember, apart from a small dip in 2020. But yes, all-time highs. Net income are the most profitable they've ever been. Not quite, but it is almost all-time highs, 89 billion, down from the prior year. Free cash flow, they do generate a lot of free cash flow, but free cash flow is down slightly, 11.62 billion. Looking at the operating cash flow versus capex, capex has increased quite a bit, but operating cash flow is down, which is why we have these values here. Outstanding, we're not going to look at these, but you can see here this is due to the splits and things, but the shares have been relatively the same. They're not really doing any buybacks. Okay, so let's have a look at the discounted free cash flow model. This is the way of buying stocks, looking at future free cash flows, discount them today's value. Let me just update the weighted average cost of capital. So currently it's giving us -10, but let's have a little look why. In terms of revenue, let me do this one actually. In terms of revenue, you can see it's decreased recently. What did the analysts say in terms of revenue over the last few years? Or the next few years, 372, 389. So they're expecting even less. Net income margins, I think that's about fair. We might increase this just a little bit actually. I think it's probably a little bit low. We'll put that to 26%. And then, let's take an average of these years here. We'll go 23. See, that still puts us at less than $200 a share. So discounted free cash flow doesn't really like the stock at the minute. I'll talk about more why in a sec. Ben Graham formula for intrinsic value. Now, yes, this looks very good, but this is with the BRK share price. Currently, as I said before, it's about fairly valued as the price is around 700,000. This is 695. This is with the expected growth rate of around about 5%. And if we go to here, you can see the expected growth rate. Oh, it's actually a little bit higher. Sorry, 5.72. So actually, this is a buy according to Ben Graham. Quite funny that he would like this stock. With the AAA bond yield as high as it is. Comparable company model. Ignore the missing prices just because Google Finance doesn't like the BRK. It needs to have a full stop. We're going to look at some competitors. Now, what we will do is I will look at some sort of conglomerate and holding companies. We have MLK. We have MKL, this is Marco. We've got Lowe's, which is a conglomerate, and we'll do BAM as well, which is Brookfield. Just to say, we won't go through these quickly because some of these don't have the EV, EBITDA and stuff. But as you can see, they're a lot smaller than Berkshire Hathaway. Yeah, so we do. They don't have a 4P. That is annoying. Okay, fine. We'll continue anyway. So Growth, Berkshire is one of the highest, obviously most profitable, most profit, highest margins. Price to sales lower than the market average. Price to book lower than the market average. PEG pretty high, but still good. EV to revenue, one of the lowest. This is BAM's bringing this up. So numbers all over the place here. Let's compare it differently again. What we'll do is looking at the S&P 500. Berkshire is 6th. Meta, Amazon, Nvidia, Microsoft, and Apple are ahead of it. So just for giggles, let's just do Apple, Microsoft, and Nvidia. Now, if Berkshire was trading at these valuations, let's see what it says. PE a lot lower than Apple's, forward PE lower than Apple's. EV to revenue looks pretty low. Yep, see, so $900 to $600 a share. Obviously, we can't. The average of them is somewhere in the region of, let's say, what, 800? Yeah, 820. So compared to its competitors in a similar size, it is massively undervalued. Now, yes, the discount free cash flow model didn't really like it too much, but if we go back to, we go Yahoo Finance here, we look at the balance sheet, and then we have a look at the total assets. Cash and cash equivalents, just shy of 50 billion. Now in the total investments, and looking at short-term investments, that's about 290 billion, so about 330 billion in short-term investments, which is US treasuries, things like that, and cash equivalents, so that's 330 billion. Now, if this is the buying opportunity that a lot of people think it is, obviously we don't know in the short term what's going to happen with the market. I mean, it looks like it's going down and going to continue to go down for a while, but Warren Buffett has said historically that the market has been overvalued recently, and is this a time for him to jump in and deploy that 300 billion in cash, buy up lots of things that he deem is undervalued, and then when the market rebounds, or hopefully when the market rebounds, Berkshire will have outsized returns compared to the market and will be up massively. So this is the gamble, although it's not that much of a gamble, that people are wanting to take. Is this the right time to buy Berkshire and trust in Warren Buffett to deploy the capital and then in turn beat the market? Now, that is the question. People have been against Buffett recently, but now everyone's saying he's the greatest investor again, which is probably closer to the truth. Let me just go to the Class A shares and just compare about the S&P 500. So over the last year to date, Berkshire is up, S&P is down. Year, Berkshire is up, S&P is down. 5 years, Berkshire is up massively, 150%. The S&P 500 is only up about 82. Right, guys, thanks for watching. Please give a like on the video if you enjoyed. Subscribe if you're not already. Check out my Patreon. And I'll catch you guys next time.